Hi, my name's Ben from Great Britain Estates, and today we're talking about guaranteed yields. I'm with my good friend Nat Ciccone, who's one of our senior property consultants. Nat, when someone's buying an investment property and they're guaranteed a certain amount of yield for a certain period of time,
yes,
that sounds brilliant, but is there anything that people should be aware of given that...
Yeah, it's a very interesting point with yields, because obviously people can get sucked into the fact, there's a guaranteed yield there, but the question is, if a company's offering something like, say, 10-12% yield guaranteed, very often that can be over-exaggerated, and often you'll find that they're quoted gross, not net, of any costs that you might have associated with the property. In the longer term, when you're further down the line and you've gone past that 2 years, you can often find the yields will drop off dramatically, and you're not really getting the returns at all that were advertised for that property in that location. So
is there anything people can do to guard themselves against this problem?
Well, yeah, for sure. Obviously, it's making sure that with regards to your yield, that it's a genuine yield that's being advertised. That the property is in the right locations for getting those ongoing yields, in terms of being an everyman opportunity, somewhere where everybody wants to live and work. The amenities are in the local area. That it's not sort of in a place where, for example, you might be looking at a very low value property, a very high value property, where if the market changes, the rental incomes from those sorts of properties are the first to suffer.
So when someone's presented with an opportunity with high yields, and that's obviously attractive, what other things should they be looking at when they're making that decision?
So that's really key. I mean, essentially, you can't just focus on a very high yield opportunity to be the be all and end all of your decision when you're looking to buy a property. At the end of the day, if you're looking at it for a long-term investment, growth is as important, if not more important, than the immediate income that you're going to receive from that property. Obviously, you want to make sure that all your costs are covered and your mortgaging expenses covered, etc. But really, what you're looking for is that growth in the property over a much longer term. And clearly, if the property is located well, and it's not, it's not at the very bottom end of the market, something somebody wouldn't want to buy, if the market changed, or very expensive property that would suffer if the market changed. In that sort of situation, you want to be in a property, or owning a property that is going to perform well in a changing marketplace.